Good evening friends. Today we have a session on changes made to tax audit report form 3CD for the assessment year 2018-19. So we are going to discuss all the new clauses whatever are inserted or amended in this audit report. Friends, I have with me a new audit report format 3CD. In the video's description we are also having a presentation made on this particular topic. So you just download that presentation, you just keep this particular copy of 3CD with you to understand clause by clause what are the changes made in this tax audit report. Friends, on the first page there is part A, clause number 4. We simply need to give GST number along with the excise number, service tax number, etc. So as GST has come into force from 1st of July 2017, we are required to give GST number. So minor change, nothing more to discuss. Now friends, in this audit report, if you see in clause number 19, this clause is basically about certain specific deductions under certain specific sections starting from 32AC, 32AD, 33AB up to 35E. In this particular list, friends, from the assessment year 18-19, they have also added section 35AD. So we need to discuss which are the things given in section 35AD on which we are required to report in this 3CD. Friends, section 35AD has come into force from assessment year 10-11. So it is not a new section, but the reporting requirement has been inserted from this year only. This particular section says, friends, there are certain specific kind of businesses, 14 businesses are listed. If let's say you are doing those kind of businesses, you have incurred capital expenditure for those businesses like cold storage, then after hospital, housing projects, etc., etc., then 100% of the capital expenditure incurred during the previous year will be allowed as deduction under section 35AD. However, only certain things you need to take care. First, the expenditure incurred on acquisition of land or goodwill or financial instruments are not allowed. So they are not eligible for deduction under section 35AD, land, goodwill, financial instruments. Second thing, friends, any expenditure which is incurred and the payment of which is made by a person otherwise than by account, pay, check, draft or use of electronic mode by a banking channel which is exceeding rupees 10,000, that is also not allowed under this particular section. So if a payment exceeding 10,000 rupees is made otherwise than by account, pay, check, bank draft or electronic clearance system of a bank, then section 35AD will not give 100% deduction of these things. So in clause number 19, this section 35AD has been inserted. Now friends, next clause, the next changes are on in case of clause 24. In case of clause 24, friends, earlier they gave amount deemed to be profits and gain under section 35AC, 33AB, 33ABA or 33AC. Here friends, they have added 32AD. So profits or gains under section 32AD is also required to be reported now under clause 24 of the new 3CD. We need to understand what is 32AD, friends. 32AD has come into force from assessment year 16-17. It is applicable when a company or any other person sets up an undertaking in a backward area notified by central government in the area of Andhra Pradesh, Bihar, Telangana or West Bengal. It is basically investment allowance. Now the amount of investment allowance is 15% of actual cost of the new assets. The definition of new assets is whatever is given in section 32AC, the same definition of new assets are given. So 15% of actual cost of new assets will be given to you as investment allowance. Now the lock-in period of this investment allowance is 5 years. So not a major change. 32AD was not added earlier in clause 24. Now section 32AD is added in clause 24. Now friends, another minor change. In case of section 43B, which says that certain kind of deductions will be given to you or certain kind of expenditure will be given to as deduction only when you are making the actual payment of them. So section 43B, A, B, C, D, E and F was earlier there in 3CD. Now they have added section 43B clause G also. Clause G is on payment made to Indian Railways for use of any asset of the railway. So if you are making that particular payment, only then the deduction is allowed. So you are also required to report under 3CD along with other clauses 43B clause G. So a minor change. Now certain important things, friends. After clause 26, now we are going to clause 29 capital A and 29B, 29 capital B. Now 29 capital A, friends, in that there is a reference of section 56 to 9. This section says whenever during the negotiation of transfer of a capital asset advance is received and advance is forfeited afterwards, the transfer is not made and the advance is forfeited afterwards, then the year in which this forfeiture is made, in this particular year, it will be considered as an income from other sources of the person who has forfeited this advance. So this is applicable from assessment year 15-16. It is not a new section, but still it has been added in 3CD reporting from this year. So you are required to report if there is any kind of forfeiture of the advances for transfer of capital asset. Very important thing is this is applicable only when there is a transfer of capital asset. For example, let's say if I am negotiating transfer of rural agriculture land and the advances are forfeited, then this will not be covered under this 56 to 9. The reason is rural agriculture land is not considered as capital asset. So only for capital assets you are required to apply this 56 to 9. Forfeiture of advances. 29 capital B, friends. This is also not a new section, 56 to 10. So 56 to 9 we have understood. Now we are understanding 56 to 10. Friends, 56 to 10, the scope of this particular section has been extended from assessment year 17-18. What this particular section says and what we need to report. This particular section covers 5 categories of transactions. Number 1, any sum of money by way of cash, check, etc. received from any person. Now if aggregate of this particular amount received exceeds 50,000 rupees during the previous year, then whole of the amount received will be chargeable to tax as income from other sources under section 56 to 10. That means we are required to make the total of all the money received from a person, from all the persons by a specific SSC, and if that amount is exceeding 50,000 rupees, then total amount received will be chargeable to tax under section 56 to 10. This is the first clause or first category. Second category is, friends, when you are receiving immovable property without consideration. Now if you are receiving immovable property without consideration, then if the stamp duty value exceeds 50,000 rupees, then full stamp duty value will be chargeable to tax. Third category is, friends, when you are receiving immovable property with inadequate consideration. That means stamp duty value and your actual consideration, there is a difference. Stamp duty value is more, actual consideration paid is less. And if the difference is more than 50,000 rupees, for example, let's say your stamp duty value is 2 lakh rupees and actual consideration given is only 1,40,000 rupees, so the difference is 60,000 rupees. So if this particular difference is more than 50,000 rupees, full difference will be chargeable to tax. One thing you need to understand, friends, the new provision, that is this particular section or this particular clause, will be applicable only when the stamp duty value is more than 105% of the actual consideration. That provision is applicable from assessment year 19-20. So in this current year's audit report, you are required to simply apply stamp duty, actual consideration. Difference is more than 50,000 rupees, then full difference will be chargeable to tax. So 3 categories over. Fourth category, friends, when you are receiving a movable property without consideration and the fair market value of this particular property is exceeding 50,000 rupees, then the full market value will be chargeable to tax. Fifth category, when you are receiving the movable property and the difference between whatever consideration you are paying and the fair market value is exceeding 50,000 rupees, then the full difference will be chargeable to tax. Now one thing we are required to understand, friends, as far as the movable properties are concerned and the money is concerned, you are required to club total transaction during the year. But as far as immovable properties are concerned, you are required to verify only a single transaction, if the value or the amount exceeds 50,000 rupees or not. So 5 categories: number 1, money received; number 2, immovable property without consideration; number 3, immovable property with inadequate consideration; number 4, movable property without consideration; number 5, movable property with inadequate consideration. As far as the fair market value is concerned, friends, you are required to find out the fair market value by applying rule number 11U and 11UA. So accordingly you can find out the fair market value. Yes, of course, friends, certain exemptions are given from this particular section. They are saying if you are receiving amount from relative, or let's say on the occasion of marriage, or by way of will or inheritance, or in contemplation of death, or from local authority, etc., etc., then this section 56 to 10 is not applicable. So two sections which were earlier there, 56 to 9, 56 to 10, they are added in this reporting requirement under form 3CD from assessment year 18-19. So these are not new sections, but the reporting requirements are added. Let's go ahead, friends. Now one very important thing, that is 3 new things are added: 30A, 30B and 30C, new clauses. But friends, these are related to transfer pricing, international transactions. So at the end of this particular presentation, I am going to discuss these things in very much detail, because it is having reference of 92CE, 94B. And friends, 30C clause deals with section 96, which is GAR, General Anti-Avoidance Rules. Now friends, these rules comes into force from assessment year 18-19. How? Now friends, one very important clause, clause 31. If you remember, friends, from this year, assessment year 18-19, they inserted one new section along with 269 SS and T, that is 269 ST, which restricts receipt of an amount exceeding rupees 2 lakh. Now friends, this section 269 ST read with section 271 DA, which is for penalty for this kind of transactions. The restriction is not on the payer, the restriction is on the recipient. But the reporting requirement given under 3CD is for recipient as well as for payer both. So recipient is also required to disclose and the payer is also required to disclose. Let me give a brief explanation of what this particular section says, which is a new section in assessment year 2018-19, 269 ST. This particular section says, friends, if a person receives an amount of rupees 2 lakh or more, otherwise than by account paid check or account paid draft or by use of electronic clearing system of a bank, in one day from same payer or for same transaction or for same event or occasion, then he is liable for penalty under section 271 DA, which is equal to the amount of transaction or equal to the amount of the receipt. Now understand, friends, here 3 lakhs are there in one day from the same payer, number 2, or for a same transaction or for same occasion or event. Now let me give you certain examples to understand these things, whether this kind of transaction will fall under section 269 ST or not. Let's say Mr. A issues invoice number 10 for sale of goods of rupees 5 lakhs to Mr. B on 25th of May 2017. Now Mr. B makes payment as under 27th of May. He is making the payment of 1,50,000 rupees by cash. On 29th of May, he is making the payment of 1 lakh in cash. On 31st of May, he is making payment of 2,50,000 rupees by RTGS. Now, here the question is whether Mr. A will fall under 269 ST or not. Then yes, he will fall under section 269 ST, because even if he has not received an amount exceeding 2 lakhs rupees in one single day, he has received 1,50,000 in cash on one day, 1 lakh rupees in cash on another day for same transaction. There is a sale of goods made on 25th of May. Hence, he has received in cash rupees 2,50,000. So, he is liable to pay penalty equal to 2,50,000 under section 271D. Now, friends, let's change this particular example. He has received like this: 1,50,000 cash, 1 lakh rupees in cash, 2,50,000 by RTGS on different dates. Suppose he has issued different invoices for these transactions. In this situation, he is not falling under section 269 ST because he has neither received rupees exceeding rupees 2 lakh in one day, nor it is for a same transaction. Hence, he is not falling under section 269 ST. Let's make another change in this example. For this 5 lakhs rupees transaction, he issued different invoices. 3 different invoices. 1,50,000 rupees, 1 lakh and 2,50,000. But amount received is like this. On 27th of May, he received 2,50,000 rupees in cash. And on 31st of May, he received 2,50,000 by RTGS. Question is whether he will fall under 269 ST. Then yes. Even if the transactions are different, he has received more than 2 lakhs rupees in one single day from the same payer. Hence, he is liable to pay penalty equal to 2,50,000 rupees, which is the cash amount received by him from Mr. B on 27th of May under section 271D. So, this is about the same payer and transaction. Now, about event. Let's take an example. Mr. A is a wedding planner. He issues different invoices for the marriage function of son of Mr. Y. Invoice number 1, 1,50,000 for decoration. Invoice number 2, 1,10,000 for catering. So, 2 invoices, 1 for decoration, 1 for catering. None of them exceeds 2 lakh rupees. Amount received is like this. On 27th of May, 80,000 cash. On 29th of May, 70,000 rupees cash. On 31st of May, 60,000 rupees cash. On 5th of June, balance 50,000 by RTGS. Question is whether he will fall under section 269 ST. Then the answer is yes, he will fall under section 269 ST because marriage is an event or occasion. And even if he has issued different invoices, he has received this particular amount for this occasion and the total amount of cash receipts exceeds 2 lakhs rupees. So he has received total 80 plus 70 plus 60. That means 2,10,000 rupees in cash. So he is liable to pay penalty equal to 2,10,000 rupees. So we need to understand these 3 important legs of section 269 ST. Question is what we are required to report. Now friends, clause 31, in that they have added BA, BB, BC and BD. Now BA and BB are the reporting requirements for the recipient. Now recipient is required to disclose what? If the recipient has received this particular amount otherwise than by check, draft or ECS, then he is required to show name, address and PAN of the payer if available with him, nature of the transaction, amount of receipt and date of receipt. But if he has received by check or draft but not account pay, then he is only required to disclose name, address, PAN of the payer if available and amount of the receipt. Same kind of reporting requirement is given under clause 31 BC and BD for the payer. Payer is required to disclose what? If the payment is made otherwise than by check, draft or ECS, then name of the payee, address of the payee, PAN of the payee if available, nature of the transaction, amount of payment, date of payment. But if the payment is made by check or draft but not by account pay, then he is required to disclose name, address, PAN of the payee if available and the amount of payment he is required to disclose. So important thing is 269 ST gives restriction on cash transaction above 2 lakhs rupees. The restriction is for the receiver, but under 3 CD the disclosure will be made by receiver as well as by the payer. In our presentation all these examples are given friends, so you can just go through those examples, you can understand these things in detail. Now friends, suddenly they realized that there is one section 222E, section 2 subsection 22 clause E, which is deemed dividend. Now in the reporting requirement under 3 CD this particular section was not there, so now suddenly they realized that on these things also we need to take a reporting from a chartered accountant. So they have added these things. They are saying that whether the SSC has received any amount in the nature of dividend as referred in 222E, and if yes, then disclose following: amount received and date of receipt. So friends, 222E we need to verify. This is absolutely not a new section. It was there earlier also, but the reporting requirement is added from assessment year 18-19. This section simply will understand. Applicable only for closely held company. It is applicable when loans and advances, or loans or advances, are given by a company to a registered shareholder or to a concern in which such registered shareholder has substantial interest. Now friends, which kind of registered shareholder? Registered shareholder must be having 10% or more of the equity shares in a company. And what is the concern in which he is substantially interested? Then if he is entitled to at least 20% income of such concern, then he is considered as substantially interested in that concern. That means, suppose Mr. A has 15% shares of A Limited, and A Limited gives loan to Mr. A, then this will be considered as deemed dividend under section 222E up to an amount of accumulated profit of A Limited. Now friends, Mr. A is having a partnership firm, ABC and Company, and in that particular partnership firm, Mr. A has 30% profit share, and A Limited gives loan to ABC and Company partnership firm. Still this will be considered as deemed dividend 222E. So this will be considered as income under 222E. So we are required to report on 222E. Very important thing is, friends, if these conditions are fulfilled, then to the extent of accumulated profit excluding capitalized profit, this will be considered as deemed dividend under section 222E. However, this is not applicable to a company where money lending is a substantial part of business of the company. It is also not applicable for trade advances. For example, let's say Mr. A is a shareholder of A Limited. He is having 15% shares. From Mr. A Limited wants to purchase something. So for that they have given certain amount in advance. Then this will not fall under 222. It must be loan or advances of financial nature and not trade advances. So an old section, reporting added in this particular assessment year by way of clause 36 capital A. So friends, as per section 285BA, we need to furnish a statement of financial transactions, and we are required to furnish form 61 or 61A or 61B. So just like TDS returns, we are also required to disclose here whether what is the due date of this form, the date on which it is furnished, whether it is furnished or not, and all the particulars which are required to be furnished under 285BA are furnished or not. So not a big thing. 42A. Now friends, there is clause 44 which is about breakup of expenditure about GST. Now there is a huge problem about this particular clause 44, and by notification they have said that this clause will not be applicable up to 31st of March 2019. So just like clause 30C, clause 44 of GST reporting is also not required to be done up to 31st of March 2019. So friends, these were the changes made to form 3CD. Three things we skipped: 30 capital A, 30 capital B and 30 capital C. Now we need to discuss these three clauses in detail because they are related to transfer pricing arrangements, friends. Now from assessment year 2018-19, two very beautiful sections are inserted in transfer pricing, that is section 92CE and section 94B. Now first friends, whatever section 92CE is there, that reporting we are required to make in clause 30 capital A. Let's understand what this particular section 92CE is there. Please understand, this section comes into force from assessment year 18-19 only. This section says, whenever as a result of determination of arm's length price, there is an adjustment because of which the total income of the SSC has increased or there is a loss reduction, then it is called primary adjustment. Now friends, 5 kinds of primary adjustments they have suggested. One is there, the SSC himself has made the adjustment in his return. Number 2, the assessing officer has made that particular adjustment and the SSC has accepted. Then advance pricing agreement, whatever is there friends under 92 CB, so that particular adjustment has been made. 4 is friends safe harbor rules. According to those particular rules, adjustments are made. That means the amount of arm's length price is increased. Or friends, a resolution of the assessment by way of mutual agreement according to DTAA. That 5th kind of adjustment is made. In short, by way of any of these 5th adjustments, your total income is increased. That means the arm's length price, whatever is there, that is adjusted in such a manner that the income of the SSC is increased. This is called primary adjustment. Now once primary adjustment is made under the relevant sections of transfer pricing and the primary adjustments amount is exceeding 1 crore rupees, then friends they are saying within 90 days from the date of such adjustment, this fund must be transferred to India from the foreign associated enterprise. So the period of repatriation to India is restricted to 90 days. That means within 90 days this particular fund must come to India. If this particular fund is not coming to India, then section 92 CE will come in the picture. This particular section says, now this is the adjustment made to arm's length price. That means this is the extra amount enjoyed by the foreign entity, that is the associated enterprise. And this will be considered as a deemed loan given by the Indian entity, that means our SSC, to the foreign entity. And on that a notional interest will be added in the income of the SSC. Again friends, to understand these things clearly, we are saying that according to relevant provisions of transfer pricing, arm's length price is adjusted in such a way that the total income of the SSC is increased or the loss is reduced. This adjustment results into an amount exceeding 1 crore rupees. That means the amount of adjustment is exceeding 1 crore rupees. Now compulsorily this fund must come from the foreign associated enterprise to Indian company within 90 days of the adjustment. If it doesn't come, then this will be considered as a deemed advance or loan given by Indian entity to foreign entity, their foreign associated enterprise. And on that whatever notional interest is there, that will be added in the income of SSC. 2 relaxation. Number 1, if the primary adjustments amount does not exceed 1 crore rupees, no need to apply 92 CE. Number 2, if the primary adjustment is made in respect of assessment year 16-17 or earlier years, then also this particular section will not come in the picture. That means if the primary adjustment is made in respect of assessment year 17-18 or afterwards, only then 92 CE will come in the picture. So friends, one more thing is that how to compute the deemed interest or notional interest. Then they are saying if the transaction is in Indian currency, then SBI lending rate you take and you add 325 basis point. If it is in the foreign currency, you are required to take LIBOR and you are required to add 300 basis point. So by this particular computation, you can have the notional interest which will be added in the income of SSC. So this was 30 capital A, new section 92 CE. Now friends, another very interesting section 94B added from assessment year 18-19, on which we are required to make a reporting under clause 30 capital B. Now friends, this particular section 94B, it's a technical section to understand, so let me make it simplified. This 94B is based on thin capitalization rule. What is thin capitalization rule, friends? For the purpose of, let's say, a tax adjustment or reduce the tax liability, what kind of adjustments are made? There is a foreign country where there is a tax rate which is low. So the profit is accumulated there, less tax is paid and a fund is generated. Now this particular kind of fund is given as a loan to Indian entity. Now Indian entity has borrowed this particular loan from foreign entity, which is their associated enterprise, on which Indian entity is paying interest. Now this particular interest is tax deductible. So two kinds of benefits are taken. Number 1, profit is accumulated at a jurisdiction where there is a less tax. The fund is taken as a loan on which interest is paid, and interest is taken as deduction under income tax. There is a thin capitalization. Because of these things, the Indian government is losing the revenue. To avoid this particular kind of things or this kind of adjustments, they are saying, they inserted section 94B. This particular section says, if let's say there is a borrowing from an associated enterprise and the borrowing is taken by Indian company or a permanent establishment of a foreign company which is in India, and any payment is made which is in the nature of interest and the amount exceeds 1 crore rupees, then certain portion of this particular interest will be disallowed. How much will be disallowed? Then they are saying lower of, number 1, total interest paid by the Indian entity to anyone, not only the associated enterprise but to anyone, less 30% of earning before interest, tax, depreciation and amortization. That means total interest less 30% of earning before interest, tax, depreciation and amortization. And number 2, actual interest paid or payable to associated enterprise, whichever is less. To understand these things, friends, let's take an example. Earning before interest, depreciation and amortization of A Limited is 200 crore rupees. During the year, it has paid total interest of 65 crore rupees. Out of that, associated enterprise interest is 20 crore and non-associated enterprise is 45 crore balance. Then how much out of this particular interest paid, that means 20 crore rupees to associated enterprise, will be disallowed? Number 1, your total interest is how much? 65 minus 30% of earning before interest, tax and depreciation and amortization, that is 200 multiplied with 30% comes to 60. So 65 minus 60 comes to 5 crore rupees. And number 2, actual interest paid to associated enterprise, that is how much? 20. So lower of 5 and 20, that is 5 crore rupees will be disallowed. This disallowed portion will be allowed to be carried forward for a period of 8 years. So very interesting section added, and we are required to report under clause 30 capital B. It is applicable when a borrowing is taken from associated enterprise which is in the foreign country by an Indian company or permanent establishment of a foreign company which is in India, and the amount of interest or the payment in the nature of interest exceeds 1 crore rupees, then this provision will be applicable. The example and everything is given in the presentation. You can also refer these things. So two very interesting sections, 92 CE and 94B, added from assessment year 18-19. Reporting requirements are given for in this 3 CD for the assessment year 18-19. 30 capital C, that is reporting on general anti-avoidance rules. These are applicable from assessment year 18-19, but up to 31st of 2019 they are saying you are not required to report under this clause anything. So friends, two clauses, 30 capital C and which is about GAR and 44 which is about GST are dropped. 30 capital C GAR is very interesting, but we will discuss GAR on some other day because reporting is not required to be done on GAR, but we will like to take a session on GAR on some other day, friends. Thank you very much.